Hey, what's up, guys? This is KittenTrader98, and I want to apologize for the late update because I was on a business trip in Switzerland and I missed wishing all of you a Happy New Year. So, a belated Happy New Year to you and your family members. Before we dive into the trading plan today, let me show you some photos I recently took in the mountain of the Alps. Check out these two pictures. They represent opposite seasons but were taken on the same day in different altitudes. You might think of spring when you look at the left one, but you may think of winter when you look at the right one. But together, they represent March when the mountain starts turning green, but the top remains white. So this ties into my trading philosophy. To succeed, we need to not only dive into the details, but also have a big picture of how the market works. All right, let's now get down to the business. Today, I want to talk about my trading plan for Charles Schwab Corporation. Charles Schwab is a savings and loan holdings company that provides wealth management, securities brokerage, banking, and financial advisory services. They are operating entirely in the US and have two segments: investor services and advisor services. Investor services make up 75% of the operating income, and including retail brokerage, banking services, and retirement plan services. While advisor services, on the other hand, makes up the remaining 25% and provides custodial, trading, retirement business, and support services. Currently, Charles Schwab is trading at 51.91 US dollars on the New York Stock Exchange under the ticker as SCHW. I believe the target price in the short term is at least 57.5 to 60 US dollars, which represents a 10% upside. And my plan today is to buy in the call option with the 3-month tenor and a strike price of 57.5 US dollars. However, if the stock price hits my stop loss at 48.5 US dollars, I will cut my loss and exit the trade. Now let's dive into my underlying logic for trading this ticker. I'll cover 4 perspectives: fundamental reasons, technical analysis, industry analysis, and macro analysis, as usual. Firstly, from a fundamental perspective, Schwab's business is performing quite well. They recently updated that inflows remain strong, with core net new assets totaling 41.7 billion US dollars in February, which stands for the second largest inflow for February ever. And this momentum has continued into March as well, with daily net new assets averaging nearly 2 billion US dollars per trading day, month to date, which are tracking consistent with the February data. And Schwab's access to liquidity is also very noteworthy, with more than 80% of the total bank deposits falling within FDIC insurance limits. This stands for top 5 highest ratio of the top 100 banks in the US. And they are now projecting a 10% year-over-year revenue growth for Q1 as well, which signals very strong and stable operations. Second, from the technical perspective, you might be aware that the stock price was recently hit with waves of unrelenting selling and worries bank could disappear overnight, and an extremely fluid deposit situation. From the price chart on the right, you can see 2 gaps in the stock price. The first one was on March 9th, where the first gap was created due to an intensified selling in bank stocks because of the double whammy of Silvergate and SVB Financial. And the second gap was created yesterday, where the market was pricing in a feedback loop between plunging bank stocks and the signals this sends to deposit holders as the former sells panic in the later. Although it's not 100% certain that these gaps will get filled sooner or later, but it also represents a trading opportunity for all of us to answer the question by ourselves, like how the gap was created and how different parties react would eventually lead to how and when the gap get filled. So this is a question which you may get a more granular answer when you see the big picture across the industry and macro. So now let's move on to the industry perspective. First of all, on Sunday night, the Fed, FDIC, and Treasury has made 3 major announcements that should bring some comfort to the market. First of all, the depositors at SVB will be able to access all their money starting Monday, March 13th. Second, Signature Bank failed, becoming the 3rd bank to collapse in less than a week, following Silvergate and Silicon Valley. However, like SVB, all Signature Bank depositors will have access to their money on Monday as well. And third, the Fed is creating a new facility called the Bank Term Funding Program, which will offer loans of up to 1 year to banks pledging treasuries, agency MBAs, and other qualifying securities. One thing to note is that this collateral will be valued at par, meaning that all the mark-to-market losses that banks are sitting on will be ignored for the purpose of these loans. The BTFP will be backed by $25 billion from the Treasury, and Fed officials say that the facility is large enough to cover all uninsured deposits at US banks. What's positive about this development is that guaranteeing all depositors at Silicon Valley and Signature sets a precedent that similar treatment would occur at other banks as well. This, coupled with the new BTFP, should help stem some of the aggressive deposit flows that were occurring last week. The fact that BTFP will lend against treasuries and agency MBAs valued at par is a crucial feature of the facility, as it essentially obviates the huge mark-to-market losses many banks are sitting on in their securities portfolio. However, the fact that there were a 3rd bank failure in less than a week is alarming and points to a wider degree of contagion that was previously known. The BTFP is certainly positive, but it's not true deposit insurance, and there will likely be a stigma associated with any banks that utilize it. The FDIC has the authority to guarantee all deposits at an individual bank if that institution is considered to be a systematic risk to the broader financial system. However, to actually raise the $250,000 ceiling for the whole industry would require an act of Congress. So taking all this into account explains why the regional banks' shares are down so dramatically yesterday. But it's not only just the small banks that are seeing default risk increase. All the global majors are seeing CDS spread rise because the deposit crisis will pressure net interest margin and earnings for all these banks. This sudden disappearance of 3 banks in less than a week has created fresh panic among regional bank investors, which explains some of the extreme stock declines occurring yesterday. To investors, the most important question here is, in what condition will the gap get filled? The signaling effect of plunging equity prices will feed back to depositors if it continues unchecked, exacerbating outflow pressures. Therefore, further confidence-building steps need to be taken, including getting a prominent investor on board to anchor any offering or public commitments from companies or individuals to increase deposit balance, or aggressive insider stock purchases by company executives and board members, or granular details on deposit flows and liquidity conditions like what Schwab has to on Monday. And for regulators, Just as the Fed can't deploy its full toolkit, the Treasury and FDIC face political constraints as it is hard to imagine Congress passing legislation to help stabilize conditions. However, the government can still pull powerful levers independent of the legislative process, as they showed with the BTFP and a blanket guarantee for all depositors at SVB and Signature Bank. In addition, the FHLB system, a government-backed source of liquidity for the banking industry, on Monday has sought to raise an enormous amount of cash as it prepares to provide more support. So, to investors, the vital question to you before all these measures taken place: do you have faith in the financial system and regulators? I will leave this for you to answer. But I want to quote a very famous sentence from Warren Buffett here. Be fearful when others are greedy, and greedy when others are fearful. Finally, on macro perspective, since Schwab is a New York Stock Exchange listed stock and is entirely operating in US, so is mainly affected by the market sentiment in US stock. So far, we are sticking with a bullish view on US stock for 5 reasons. First of all, the yields have seen their highs. It seems inevitable the dots will shift higher on March 22nd, but probably not by any more than the market has already priced in. The cycle ceiling is essentially 5.5% right now. It's still very notable that no Fed official has talked about taking rates up far beyond what the December dot plot has outlined. And second, the Fed is likely within 25 bips of hitting the cycle ceiling and probably will at least slow the quantitative tightening pace. And third, Powell may not have the same toolkit as his predecessors on account of inflation being elevated, but the economy has made substantive progress toward the Fed's goals over the last several months, giving it cover more than people appreciate to take its foot off the tightening pedal. Fourth, the deposit crisis besetting regional banks is quite serious, but this is certainly not the 2008-like scenario threatening the safety and soundness of the entire system. And finally, the corporate America remains quite resilient and earnings are benefiting from several tailwinds. For example, the aggressive cost cutting, easing supply chain strains, lower input cost, less foreign exchange pressure, and cleaner inventories, and also improved China demand. So there you have it. The stock market is a wild ride, but if you keep your wits about you and pay attention to the gaps, you might just come out on the top. Thanks for listening, and I wish you happy trading.